Welcome back to Forex Gurukul. Before you ever place a trade, you need to understand what you are actually buying and selling in this market, why some currencies get called majors, how to read the three-letter code sitting on every chart, and how professional traders keep a simple strength read going in the background. That is exactly what we are building today from the ground up. Let's start with the most basic question a new trader skips right past. What is actually changing hands in Forex? Unlike a stock market where you own a piece of a company or a commodity market where you can point to barrels of oil, Forex has no physical product moving anywhere. You are trading one country's money against another country's money. When you buy the US dollar, you are in the same instant selling something else, maybe the euro, maybe the yen. There is no dollar sitting alone on your screen. It only exists in the market as a pair, always priced against the counterpart. That single idea, always a pair, never a single item, is the foundation everything else in this course sits on. Now, here's the analogy that made this click for me early in my own trading. Think of buying a currency the same way you would think of buying a share of stock in a company. When you buy shares, you are betting on that company's future earnings, its management, its health. When you buy a currency, you are making a very similar bet, except the company is an entire nation, its jobs numbers, its interest rate decisions, its growth rate, all of it feeds into how the world values that currency. A strong, healthy economy tends to get its currency bid higher over time, the way strong earnings lift a stock. A struggling economy weighed down by weak data or political trouble tends to see its currency sold off, the way a company in trouble sees its share price drift lower. You are not buying paper money for its own sake. You are buying a share in that country's economic story. This brings us straight to what an exchange rate actually means. The rate you see quoted is not some fixed objective number handed down from above. It is the market's live opinion of one economy compared to another. If the exchange rate between the euro and the dollar is moving higher, the market is saying right now, we think the Eurozone's economic story is looking a little better relative to the United States. If it is falling, the opposite opinion is winning the argument. Every tick on that chart is a fresh vote being cast second by second, comparing two economies against each other. That is why, exchange rates never sit still. The story on both sides of the pair is always changing. Now, out of roughly 180 currencies in the world, only a handful see the overwhelming majority of daily trading volume. We call these the major currencies. The US dollar sits at the top of almost every list, appearing on one side of the large majority of all trades because it is the world's reserve currency. Right behind it, you will typically find the euro, then the Japanese yen, then the British pound. These are the currencies backing the largest, deepest economies on the planet. And because so much volume flows through them, they tend to offer tighter spreads and more reliable liquidity for a retail trader like you. Here is something worth knowing before you go looking for a definitive list online, because you will not find one everyone agrees on. Some traders keep a tight list of majors, just the dollar, euro, yen, pound, and Swiss franc. Other traders and other trading books lump the Australian dollar, Canadian dollar, and New Zealand dollar in as commodity currencies. Instead, a separate bucket, because their economies lean heavily on exports like oil, gold, and dairy. Neither camp is wrong. It is simply a matter of which framework a given source is using. The practical lesson here is not to memorize someone else's list. It is to know which camp your source is speaking from before you apply their rules to your own charts. Let's decode that three-letter ticker sitting on every chart because it is not random. The system is called ISO 4217 and it follows a simple pattern. Take USD, the code for the American dollar. The first two letters U and S stand for the country, the United States. The third letter D stands for the currency itself, the dollar. Try GBP, British pound, GB for Great Britain, P for pound, JPY, Japan yen. Once you see this pattern, you can look at almost any three-letter code on your platform and take an educated guess at both the country and the currency behind it, even one you have never traded before. One habit that separates a lot of consistent traders from everyone else is that they do not just watch one pair in isolation. They keep a rough read on relative strength across several currencies at once. The idea is simple. If the dollar is showing broad strength against several currencies at the same time, and the yen is showing broad weakness against that same group, that combination, dollar against yen, becomes a far more interesting pair to focus your attention on than a pair where both sides are roughly balanced and directionless. You are not trying to build a complicated model here, just a quick visual sense of who is strong, who is weak, and where the imbalance is largest right now. Let's put this to work on a real live euro against dollar chart right now, the exact pair this entire lesson has been built around. Before I say another word, pause the video and look at where price currently sits. Is it pushing into a fresh area of the chart, or is it sitting inside a range it has already visited multiple times? That question matters more than any single candle shape you could point to, because context on the chart beats the pattern itself every single time. Now, using what we covered today, ask yourself which side looks like the stronger economic story right now and which side looks like the weaker one. If you get a clean read that the dollar side is strong and the euro side is soft and price is pulling back into a logical area rather than sitting stretched out in the middle of nowhere, that is where a continuation entry idea can live. Your stop goes just beyond the most recent swing point with a little wiggle room, so normal noise does not tag you out early, and your target gets measured against that stop, aiming for at least a 2-to-1 reward for the risk you are taking. And remember, no read on strength and no chart context guarantees anything. Patterns and setups fail regularly. Your stop loss is the only thing standing between a normal loss and a damaging one. Let's lock in today's 5 big ideas. Forex trades currencies against currencies, never physical goods. A currency behaves like a share in its country's economic story, rising with strength, falling with weakness. An exchange rate is nothing more than the market's live relative opinion between two economies. The major currencies carry the deepest liquidity, though traders will keep arguing over where the line sits between majors and commodity currencies. And above everything else we covered, remember this one, context beats pattern always, because where a move happens on the chart tells you more than what shape it takes. Practice reading a pair's code, its relative strength, and its context every single day, and the rest of this course will click into place fast.